Before we get into this video, I want to thank all of my viewers for watching my videos and helping support my channel. I want to be able to keep making these videos and bring you news that you all want to see. Please like this video and also subscribe to my channel for more daily content. You can also help support my channel by using my referral links in the description below by signing up for Weibo and earning yourself a free stock worth $300 to $300. The best part is you don't even have to invest or make a trade, and you can earn another free stock worth $8,000 to $2,000 just by making a $5 deposit. It's a limited time promotion and you don't want to miss it. Go claim your free stock. What's going on, Ape Nation? We have a lot of data and a lot of evidence that supports heavy manipulation on the AMC stock. And now we have a former Citadel employee who explains how his former company uses the dark pools to manipulate stocks, and is also the reason why you're not getting the best prices in the stock market. Here's his recent interview with CNBC.
The SEC needs to do much more to level the playing field. Let's bring in Dave Lauer, former Citadel trader and CEO of Urban AI. Dave, great to have you with us.
Thanks so much for having me on, Melissa. I appreciate it.
It's nice that Gensler is engaging with the Twitter community, but I know from looking at the Twitter community's comments about what Gensler said today that there is a lot of skepticism about whether or not the SEC can or will in fact do anything. From your perspective, what do you think is the number one thing that the SEC should be focused on when it comes to this particular matter of routing order flow to wholesalers as opposed to lit exchanges?
Yeah, I appreciate the skepticism. You know, I've been sort of in this conversation now for almost 10 years, and I've heard about holistic reviews of market structure and you know, the need to study. And I feel like it's, you know, something that we hear a lot of and we see little action. And I think the most important thing that we should be focusing on from a market structure perspective is the fact that almost half of all trading is happening off exchange. And in some retail heavy names, you're seeing more than 70% of the volume executed in these internalizers or wholesaling systems. And that's damaging the markets. It's widening spreads, and it's a significant information advantage for those two firms, Citadel and Virtu, who operate a de facto duopoly in the internalization market. So I think that we should be looking at better disclosures, and I think we should be looking at rules similar to other countries. You know, this isn't a controversial thing. Canada, Europe, the UK, Australia all have very strong rules that prevent the internalization and off-exchange execution of small orders while preserving that functionality for institutional orders.
David, Karen, thanks for being on. So just so I understand clearly, when you talk about disclosure, are you saying make the dark pools transparent and that should help solve the problem?
Well, I would like to see more transparency, but I think we've done a good job there. You know, when I think better disclosures, I'm thinking around short positions and derivatives, that type of thing, the issues around failures to deliver and naked shorting. I think we need much better disclosures in that area, which is a major area of concern. And then in terms of off-exchange trading, I think we should require material price improvement for small orders for off-exchange trading. And in saying that, I'm only echoing what Citadel said in a comment letter in 2004, where they made the identical arguments that I'm making here.
Someone to argue, Dave, though, that with payment for order flow effectively, but the notion that retail orders, retail trades are routed to internalizers and wholesalers instead of lit markets, that they are getting better pricing. Is there truth to this?
They're getting better pricing relative to a wider spread. And this is so important to understand. The way that we route orders for retail, it means that those orders do not go to lit markets. And by taking those orders away from lit markets, you widen the spreads because everyone wants to trade against those orders. Those orders are profitable for market makers. So all I'm arguing is that we should have open competition for order flow. That should not be a controversial thing in capitalist markets. Get those orders onto exchanges. Let all the market makers compete for them. You would tighten spreads, and you would still get price improvement and size improvement for those retail orders. So I'm convinced that net, we would see far better execution quality, even for retail, let alone for institutional asset managers who would benefit from those tighter spreads by 25% or more.
That's going to be it for this video. Let me know what your thoughts are by leaving a comment. If you found this video to be entertaining, informative, or educational, please like the video, subscribe to my channel for more content, and share this video.